On everybody on another episode of the Real Estate Blueprint Podcast. Your host, as usual, Austin More Than an Agent, my Dominicano Romano co-host, John Soto. What's the word? How's everything?
Everything's great, man. I'm feeling good about this year. I'm feeling good about everything. Positive vibes only over here, man.
I got you. Any travel plans? I'm only asking because it's cold outside and I gotta get to some sun.
I know, right? With all the plane stuff going on, I don't even know, man. I haven't thought about.
It is a very real thing. So we're not calling it seasonal depression, but at the same time, it's very hard not to be happy in the sun. Today's episode, we want to just help listeners, first-time home buyers, investors, just kind of have a straight guide on how much does it take to close on a property. And with this guide, hopefully it just makes things a lot easier for you. So that way, it can eliminate some of the FAQs, the frequently asked questions, and continue to put your path onto home ownership, whether your first property or the next property. And before anything, be sure to like, comment, subscribe. Y'all been rocking with us, so we see y'all. We greatly appreciate the support that we have been getting. So please continue to share, like, comment. Let us know any feedback. We're all here from it. Okay, so Soto, our dedicated mortgage officer here. Let's just start off with somebody that's looking to purchase their first home, and then we'll go on to investors. But somebody that's looking to purchase their first home, bring us through the various loan products and which each loan product usually requires in order, as far as how much in order to buy that particular property.
Okay. So the loan programs we have your regular FHA, which is bread and butter that we love for multifamily. You can buy 1 through 4 units with as little as 3.5% down.
Okay.
That program is more lenient when it comes to credit, of course. Your second program, we have your conventional loan. You can get as low as 3% for your single family house, but there's more requirements that are needed if you want to go as low as 3%. So like income requirements and different things like that in the area you're buying. If not, if you don't qualify, it would be a 5%, and you can get up to a 4-family with 5% down. Then we have the USDA. So the actual address needs to qualify for the rural area, of course. So if you live closer to like a city, like a lot of population, not going to qualify. But if you go, let's say in Jersey, go more out west, more south, then you can probably qualify for that. You can actually do that with 0% down. And then you have your veteran loans. If you're a veteran, you can also do a 0% down and buy up to a 4-unit property when it comes to veterans.
I don't think I've ever seen anybody use a USDA loan. Have you
because
done it before?
It's the area. Yeah, you can
correct.
get
I can imagine.
to, I think 2-family. You can get a 2-family with a USDA. And it's, I would say, probably a little tougher to qualify than conventional because DTI is lower as well.
Is that something like West New Jersey? Like, is that enough to qualify for USDA loan?
My town, you can.
Really?
Yeah.
And what are the closing costs looking like? And for that
Similar. Yeah, similar.
So everything's similar.
Yeah.
Okay. So you mentioned some percentages, and obviously, let's just for the listeners, just as use an example. Let's go through the same down payment percentages with a $500,000 house.
Okay, so $500K with FHA, you're looking at about 3.5% is $17,500.
Mm-hmm.
So let's say you do qualify for the 3% for conventional, that you're looking at $15K for the down payment. If you don't, the 5% will be $25K.
Okay.
And then for your VA and USDA, it will be 0% down.
Want to do the closing costs, right? Because for everyone listening, your cash to close, your total amount of cash to close consists of 2 components: your down payment, which we were just discussing, and your closing costs. Run us through closing costs and what those are.
Of course. So when it comes to closing costs, pretty much all are pretty much the same. When it comes to FHA, of course, you have your mortgage insurance. You can put it as the closing costs, or you can add it to the mortgage. So for FHA, you have 2 mortgage insurance at closing as well as the monthly mortgage insurance. When it comes to conventional, there isn't at closing mortgage insurance. It's only the actual monthly mortgage insurance. And the funding fee for the VA can also be added to the mortgage if not paid at closing. So let's say we are adding all of it to the mortgage itself. All of the closing costs will be the same. So you're looking at your taxes, escrow. So what escrow means, you're basically putting money aside to pay for certain things that is needed within the house. So let's say the insurance needs to be paid, the taxes needs to be paid. Escrow is built because after closing, you don't have a payment right away. So you're going to be short when those items are due. So that's why escrow is needed. You have to pay for your attorney if you have an attorney. Some states don't really use attorney. But we're in Jersey. A majority.
Only Jersey and New York use attorneys.
Majority don't, but I would definitely recommend an attorney, especially in New Jersey. You have your title fees. So those titles can vary depending on like the price of the house and things like that. You have your what is called the per diem interest. So depending on what day of the month you're closing, the bank is basically charging you interest until the end of the month. So as sometimes you can notice is if you're closing the beginning of the month, your closing costs can be a little higher because you're paying interest until the end of the month. If you close on the last day of the month, that's pretty much zero because there's no per diem interest per se.
Gotcha.
What else do we have? You have your bank fees, whatever your bank is charging you to originate the loan. And then if you didn't pay your insurance up front, the premium, you're paying that at closing.
Okay.
So rough estimate, $500K home can probably be about $10,000 to $13,000 depending on the taxes, your attorney fees, and title fees.
Gotcha.
If you're paying no points. This is basically no points. What points mean is if you want to decrease your interest rate, you would have to pay a percentage of the loan for points. So 1 point is 1% of the loan amount.
Okay. Closing costs can vary, but for the most part, those are the very consistent line items, and that gives you an idea on where you can possibly be in your cash to close. But the good part about it is that when in doubt, you ask your mortgage officer. You ask your mortgage officer, and they'll be able to bring you through. But it at least gives you an idea on where you need to be at in order to, start saving and start thinking about how you're going to be able to make that move. Now, right before we get into how you can cover these costs to close, for investors, luckily for first-time investors, FHA programs for a multifamily, rental properties, at least you're able to go the same route as the single family. For somebody that's looking to flip, there are programs out there that allow you to get the money for renovations and so on and so forth. Mm-hmm. And usually you're putting 20% down for the most part, roughly.
For single family, we can do 15% conventional.
15% conventional. Investment? Mm-hmm. Investment.
And you can do a renovation too.
And you can do a renovation. Okay. So 15% down. For a multifamily, investor in the sense of they bought a couple properties and now they're going non-QM, and non-QM just means that, will you break down non-QM?
Yeah, quickly? So if you have a couple houses already, I would definitely recommend the DSCR loan, which is 20% down. It's under the non-QM, which is a qualified mortgage. It doesn't follow the normal government or agency guidelines, which is your FHA, your conventional loans. It will look at the property itself and not your reported income on your tax returns. Mm-hmm. So if the property can sustain itself, then it can qualify for the loan. So what does that mean? Let's say the rents you're getting for this $500,000 home, let's say is $5,000. Mm-hmm. Let's say the mortgage is $4,500. It meets the debt service ratio, so the rents are more than the mortgage.
I got you. The interesting part about the DSCR loans, to your point, it only just focuses on the income of the property. Mm-hmm. This is where you're getting into purchasing properties in an LLC and not under your personal name.
You can't close an LLC. Mm-hmm.
For the record, the loans that you put in your personal name will always give you the best down payment options as well as the best interest rate.
That is correct.
When you're doing when you're purchasing properties in an LLC, at that point you're automatically going into the DSCR space. You don't do conventional under DSCR, do you?
No.
I mean,
so conventional, they will.
It just has to be right on your personal.
Yeah, it would have to look at your name.
Correct.
And your personal income plus the property's income to qualify. You would have to meet the 50% ratio.
And it's probably and I'm just having a brain fart right now. But do you do can you do the LLC in a regular conventional loan?
Mm-mm.
Okay, all right.
Your
So I didn't think so.
personal
All right, cool. So anytime that you purchase a property in the LLC, you're automatically going into asset-based lending, which in that case, they're just focusing on what that property will be making rental income-wise and giving you the loan and pre-approving you based off of that. And those are usually coming 20% down. Now, the cool part about real estate is that now that we have an idea on where our cash to close is, how much in totality we need to bring to the closing table, the cool part about real estate is that in some cases, it doesn't have to be all of our money. So with grant programs that help lower or possibly eliminate the cash to close, give us some that you've worked with and kind of the behind the scenes on those.
Yeah, so the number one in Jersey, so each state has a down payment assistance program. The one in Jersey is called NJHMFA, and they can give up to $22,000 in down payment assistance. Each county has different assistance when it comes to grant. So most of, I would say, closer to New York, I would say you have the $15,000 in down payment assistance. And if you're further from like New York in the South region and closer to PA border, you're looking at $10,000. To go up to that $22K, there's an extra $7K for either counties if you're a first generation homeowner, basically meaning your parents don't own a house. So that's why you can get up to 22, the 15 plus the 7. And you can buy a multifamily with that program. Of course, there are income restrictions. So if you make above the income limits, you don't qualify for that program. The good thing is the rental income you're going to receive is not included in the income limits. So you can use that to qualify, but it won't impact your restrictions when qualifying for the grant.
And remind me, the income limits, are they, is that by territory or is it just
county,
like
Yeah, so it depends off county and depending on your family size. So the 3 or more, it's a little bit higher income limits, and if you're just 1 or 2, it's lower income limits. So I would say average probably around 150 to 160-ish, around there. So let's say your income was 160 and you were just at the limit, and you're buying a multifamily, we don't have to add that multifamily income to that. So you will still qualify for the income limits.
Which you actually have.
But you can still qualify for more if we're using the rental income to help you qualify. That makes sense. So they're using it one and not the other, which is helpful for a lot of people.
Yeah, I got you. All right, so that's one of them. You said that's the most popular one.
Yeah, that's the most you're gonna get, $22K. You have to live in the house for 5 years. It's basically a second lien on the house is a forgivable loan after 5 years. So if you sell it or refinance within that time period, you have to pay that money back.
I got you. And I know Newark has some city-based grants.
City-based grants as well. You
can always check with your local.
Yeah, you can also check. Most of the times you can't double dip. So the Jersey one, you can't double dip with a local one.
Gotcha.
But maybe there's a possibility. I would have to check. Maybe double dip in 2 local ones.
There's got to be some loophole.
There got to be some, but the one with the state, you can't double dip.
Like extreme couponing, right? And it's just like, you can't combine coupons, but there are loopholes in which you're able to.
So for the instance we had what, 17,500 plus, what was it? Let's say 12, let's say 30 all in. If you get a $22K grant, you only have to come out of pocket $8,000.
Right.
The grant does require you to have 1 month reserve after closing too. So let's say the mortgage was $4K, you need $12K, but you're only using $8K of that.
Okay. And then as we start our descent here, bring us through just where other potential sources can come from to help lower that cash
Yeah.
to close, or bring less to the closing table?
There's our favorite seller's concession. So if the seller helps you pay for the closing costs, so let's say you're getting an 8K concession, you're basically come out of pocket. You're zero out of pocket. You just have to pay for your appraisal, of course, at the beginning.
Yep.
You're basically zero out of pocket. You can utilize your 401k to buy your first house. Normally, they let you allow to borrow 50% of that. You can get a gift. You can get a gift from friends, family. Each loan program varies of who can give a gift and who cannot. Some can say friends will allow, others won't allow friends. So that's something to keep in mind. FHA does, conventional doesn't. An employer can give a gift. Let's say you're relocating or something like that. An employer can give a gift for your down payment. And like down payment assistance agency. So we have the New Jersey grant we spoke about. We spoke about the local grants within the townships. That's something you can get your down payment from a lot of different areas. If you have a family member that's so kind to give you the gift for your down payment, you can use that for your down payment.
This is why we gotta choose our friends and family wisely. You never know; they might be able to fund your next deal. The other one that I like, and we'll leave you guys with this one, is using a HELOC.
Yeah.
Using a HELOC. You didn't say that, right? No.
No, because we're looking at first-time home buyers.
Oh, first-time home buyers. I got you.
But yeah, you can. I'm doing one now that investor is pull the HELOC and they're buying a 2-family DSCR.
Yeah, and using
you can use the HELOC
and you being able to use those funds.
But if you're buying your first house, FHA doesn't allow you to borrow money for your down payment. So if they see that you took a $20K loan for a down payment, it wouldn't allow it. But let's say your friend is taking a loan out and giving that as a gift, that's allowed.
That's allowed. There we go. Listen, that is the Real Estate Blueprint Podcast. We tap in. Like I said, it's still plenty of opportunities that's out there, just in a different limelight and a different strategy. But aside from that, there are ways that you're able to lower your cash to close, and that's why we're usually telling clients that the real number that really matters is that monthly mortgage payment. That's going to be the only number that you're going to be stuck with after closing. We can help with bringing down the cash to close. We can help with grant programs. We can help in the ability to make attempts to lower those cash to close. But at the end of the day, that true number that matters is definitely the monthly mortgage payment. So we wanted to fire off this quick rapid fire episode just as a quick guide for you guys. Hope you guys are being prosperous out there. Keep grinding. Be sure to like, comment, subscribe. Keep on rocking with us. And we are good. To my Dominicano Amano co-host, and as yours truly, this is the Real Estate Blueprint Podcast, signing off.